How do you calculate break-even points for a delta-neutral straddle? If you are curious about how to determine the break-even points for a delta-neutral straddle, you're in the right place. This strategy is popular among traders looking to profit from significant price movements without taking a directional stance. Let's break down the calculation process step by step. First, you need to understand what a delta-neutral straddle is. It involves buying both a call option and a put option at the same strike price. This means you are positioned to benefit from large price swings in either direction. The initial net delta of this position is close to zero, meaning it is not sensitive to small price changes. To find the break-even points, start by identifying the strike price of the options. Since both the call and put options in a straddle use the same strike price, this will be your single value to work with. Next, you will calculate the total premium paid for both options. This is simply the sum of the premium you paid for the call option and the premium for the put option. This total premium is essential for determining the break-even points. Now, let's calculate the upper break-even point. You do this by adding the total premium paid to the strike price. This upper break-even point is the stock price above which the gains from the call option will offset the total premium you paid. Then, you will calculate the lower break-even point. For this, subtract the total premium paid from the strike price. This lower break-even point is the stock price below which the gains from the put option will cover the total premium. At expiration, if the stock price is above the upper break-even point or below the lower break-even point, your straddle position will be profitable. However, if the stock price remains between these 2 points, you will incur a loss equal to the premium paid. Since the straddle is delta neutral at the start, small price fluctuations around the strike price do not significantly impact the position's value. However, larger price movements in either direction can lead to profits. The break-even points are critical thresholds where the gains from one option start to cover the costs of both options. In practical terms, traders use these calculations to assess the risk and reward of a delta-neutral straddle. The goal is to profit from significant volatility in the underlying stock without betting on a specific direction. If the stock moves sharply up or down beyond these break-even points, or if implied volatility increases, the position can benefit. To summarize the calculations, start with the strike price of the call and put options, add the total premium paid to find the upper break-even point, and subtract the total premium paid to find the lower break-even point. This method applies to a long delta-neutral straddle. For a short straddle, the break-even points remains the same, but the trader profits if the stock price stays between these points. Understanding these break-even points is essential for managing risk and setting profit targets in delta-neutral straddle strategies within options trading.